Well, Chinese stocks rallied after government stimulus. They witnessed the best day since 2008. In fact, how is this likely to really impact the emerging market sentiment? That is our top story of the hour. And China's central bank had unveiled this biggest stimulus since COVID. The package is aimed at offering more funding and interest rate cuts. But let's go and find out exactly how is this likely to impact China and other emerging markets. For that, we are joined by Geoff Dennis, Independent Emerging Markets Commentator. Thank you so much, Geoff, for joining us today.
Thank you. Nice to be here.
Right, Mr. Dennis, tell us, stocks in mainland China surged over 8%, for the best day in 16 years, and rightly so after the stimulus that the Chinese government has, introduced. How is this sentiment-driven rally really likely to sustain over the stimulus? Because there are a lot of other internal problems that China is going through that still needs to be addressed.
I agree with your last comment. I continue to be quite skeptical about this rally that's going on, at least for the long term. The reason I think the market's gone up so much today is, number one, there's a holiday, a week-long holiday in China starting tomorrow, Golden Week, and so I think people wanted to get in there before the holiday. In other words, the fear of missing out. Everybody's been underweight China. I think that's played a role because these measures have been a surprise. So I think those have played a role. Also, the official Purchasing Managers Index for September was a bit stronger than expected. But at the end of the day, my big take on all of this is we've heard the details of the monetary policy actions that were taken by the PBOC earlier last week. They do not solve the big problem in China, which is the slow growth of consumer spending and the very great weakness, extreme weakness of consumer confidence. For that, you need the fiscal action. Now, we've had the announcement there's going to be fiscal action. We're hearing all sorts of stories that it'll be the biggest fiscal package since 2008, but that remains to be seen, and we have not seen any details. So I think until we see details of this fiscal package, I think you've got to remain skeptical about the sustainability of a rally that's pushed up MSCI China by over 20% in a week.
Right. So this rally is more of a FOMO than anything else, Mr. Dennis. But how will this, this set of impetus impact China's slowing economy and the real estate market, as property sector accounts for 30% of China's GDP, and the problem is really grave? Are these stimulus, these set of impetus, really enough to stimulate that?
As I say, we don't know. We need to see the fiscal action. We need to see the details of the fiscal policy expansion, which they're promising us. If you think about how the events panned out last week, first, we had the monetary policy action early in the week. Markets went upwards strongly. Then there was a bit of a pause, and then we heard they were going to announce the Politburo announced basically the potential for a set of fiscal measures, and the market's gone up again. I think you've got these technical factors working today, as I say, like FOMO and like the better than expected Purchasing Managers Index. But until we know what fiscal action they're going to take and how successful it will be, we just can't be sure, I think, about the sustainability of this rally. Because at the end of the day, what China needs above all is a much stronger consumer and a sharp increase in consumer confidence. Without that, this just doesn't work, basically, because underlying this, as you rightly point out, is a very, very weak property sector where a lot of consumers have suffered badly because they bought houses that have not been completed, or they bought houses and found they've gone down in value. So the key driver here long term is going to be consumer spending, and we just don't know what the fiscal measures are going to be at this point, which are going to push up consumer spending significantly to justify this rally. And that's why I am a little bit skeptical about the big rally, which is, as I say, has also been driven by the fact that everybody a week ago, 2 weeks ago, was underweight China. I think we need to wait to see what the fiscal measures will bring.
Yeah, right. So consumer sentiment is what really needs to pick up in China to, for more confidence. But let's talk about the confidence that FIIs are showing in the emerging markets. Is China now becoming a more attractive destination, given that Indian markets are fairly expensive now? Not to say that the Chinese market look more expensive, clearly, more attractive, clearly, because I mean it is still time before we actually see the economy really pick up, the demand really pick up. But Indian markets are also fairly expensive right now. Do you really think that is going to, really, change the mind of FIIs towards, or have them more inclined towards the Chinese markets?
I doubt it, frankly, in the short term until, as I say, we have more fiscal policy details. What I think is interesting, though, is that today, despite the big rise in China, EM is down slightly, and that's because there's been a 2% drop in Korea and also a fairly sharp drop in India, as you pointed out. So, as far as today is concerned, although to be fair, last week EM generally was strong, not just China. I think what the markets are telling you is they're maybe skeptical about this being an emerging market move overall, because for that, I think you need to see a much stronger Chinese economy, which spills over to having positive macroeconomic effects on other emerging economies. And as I say, we wait to see that if that's going to happen. By the way, one other point I should have made is that the Chinese economy is stuck in a 4 to 5% growth mode. And I remain unconvinced that the measures we've seen so far are going to move us outside of that. So my take here is that I think over the long term, a 6 to 12 to 18-month view, India remains the better story, in the sense that you've got much, much stronger growth. I think you've got much more clarity about the policy measures that are being taken. Whereas in China, maybe they'll surprise us with the fiscal package. We just don't know. There's too much uncertainty still about what's going on in China. Plus, of course, the dramatic overhang of the collapsing property market. So over the medium to long term, I would still much prefer India to China.
All right. Also, Mr. Dennis, what does it really mean for the crude oil prices? Now, crude prices have been declining, and China is the biggest importer of crude. Now, prices can only rise if Chinese demand or economy really picks up. Is there now a possibility of a reversal in demand anytime soon?
I think there is, of course. Again, it depends on how successful these measures are in stimulating the Chinese economy. And as I say, I remain skeptical about that. But obviously, that is a possibility. It's interesting, we haven't really seen an oil price move in the last week that you can tie, if you like, tie in with what's been going on in the Chinese market. I think a much more dominant driver of the oil price over the last 2 weeks has been the effective abandonment by Saudi Arabia of the $100 oil price target. So they're not prepared to just keep cutting output to try to get prices up. They've said they're going to raise output. So eventually, China, with these measures, may grow more strongly. As I say, I'm skeptical, but if they were to grow more strongly, that will add to the demand for oil. But at the same time, there's more oil coming onto the market, or potentially coming onto the market from Saudi, etc. It's also interesting that despite this extraordinary geopolitical mess now we've got in the Middle East, the oil price has not reacted positively to that. So I think there are still some very big fundamental drags on the oil price here, which will take a very significant increase in Chinese demand and consumer spending in China for that to be turned around. Now, other commodities, copper's done well. I get that. If the Chinese economy does better, copper in particular is going to be a big beneficiary, maybe some other commodity prices. But for me, oil is going to be driven by a lot of other factors. And right now, I don't think there's enough potential for a pickup in the Chinese economy to turn the oil price around to such an extent that we start to see big gains in the short term.
Right, Mr. Dennis. But thank you for so much for joining us and taking the time out. We will let you go on that note. Thank you so much for joining us.
If you like this video, then like, share and subscribe to ET Now.